Hi, friends. This is Colin Richards, president and founder of Lord & Richards, and I'm glad to be with you in this segment of the Lord & Richards Show. Generally speaking, if we're trying to protect our portfolio, we can take a portion of the money and exchange that low fixed interest that you're getting on that CD, that fixed annuity, the bank product, structured notes, etc. You can trade in your low fixed interest for the opportunity to earn more. So what happens is you get some of the up and yet none of the down. No risk of loss. You say, I don't believe it. It doesn't exist. Well, it does. And you can earn returns that are in excess of the typical safe money returns that you're expecting out there, like 3 and 4%. And so we're seeing average back-tested returns. That means we take the time to look backwards and see what has gone on with this thing, that in combinations actually can beat just a straight up S&P 500 portfolio. And by the way, that S&P 500 portfolio has the ability to drop 50, 55% if we repeat history, such as 2008. So let's talk about some of the ways that we can do this. I want to give you an example, and I'm going to start with the most boring example, okay? But it's not boring in the end. So fixed annuities. These are the granddaddies of annuities. These have been around and regulated in the U.S. for over 100 years, and they're designed to be safe, principal protected. Well, there's been some great research done on what happens when you take that annuity and trade in that low guaranteed interest and let them leverage it. They actually go out and buy options with just your interest, leaving your principal protected, and trading in the interest with options to attach to a market index, such as the S&P 500. And would you believe that in rolling 5-year periods since 1995, these types of annuity beat the S&P 500 in 67% of cases? And when we combined that with bonds, so we said, okay, we're going to say stocks and bonds, and we combined that, the index type annuity won in 79% of cases. Now, I'm not saying this is actually our target. It's just fascinating because sometimes we think, oh, if I'm safe, I'm protected, I don't have any growth opportunity. Well, that's just not true, 100% not true. You can have tremendous upside potential. You can see returns on these vehicles that are double-digit returns, just like you're expecting from the market, but without the downside. Okay. The key here is they are long-term in nature. So this type of bond replacement is designed to replace the returns you expected from bonds but never got, but also add in the principal protection you never seem to really get from bonds when markets go haywire. So toss out the bonds and let's take a look at a portion of your portfolio being absolutely principal protected. We call this principle the barbell. I'll talk about it till the cows come home. I borrowed the terminology from Morgan Housel in his excellent book, The Psychology of Money, which I recommend to all investors as a study in the difference between great investors and unsuccessful investors, billionaires and those who are unsuccessful in their attempts to make money in the market. And we call it a barbell, where on one side you put safety and protection with less liquidity, but enough to live on, right? We need to be able to draw out an income. And then on the other side, we have an aggressive portfolio, maybe primarily S&P 500 or other aggressive stocks. And your risk is being counterbalanced by the absolute safety and protection on the other side. This is a strategy that we use day in and day out to bring peace, safety of mind, worry-free retirement, what we call retirement freedom. I'd love to talk to you more about how you can integrate this into your own planning through a relationship with Lord & Richards. It just starts with a phone call. Hi, friends. This is Colin Richards, president and founder of Lord & Richards. And once again, I am thrilled to be with you on this episode of the Lord & Richards Show. And today we're talking about how to replace bonds in your portfolio related to the guiding principle of Lord & Richards to manage risk as a steward, knowing that this money's been entrusted to us by God. It's been put in our hands for our support, but also for the advancement of the kingdom. What is the wisest way to manage risk? And in our last segment, we talked about really the futility that bonds have been as a risk manager. I don't mean they're not an investment choice, I'm just saying if you're using it to counterbalance stocks, it's no longer considered the go-to. And we talked about how to incorporate principal protection into your portfolio. And I used one example. I used fixed annuities, but we can also use certificates of deposit, which are 100% principal protected. There is a time delay on accessing your money. We're all familiar with that. So this isn't optimal for retirement like maybe a fixed annuity would be, but optimal for a time deposit. One question I do get asked about fixed annuities is, Colin, don't they have high fees? Well, actually, you can do the type of investing I'm describing with no fees, absolutely no fees, just like you would with a certificate of deposit. We don't usually pay fees on those. So there's a lot of misinformation around the use of these types of tools. But one of the other objections sometimes that people raise is, will say, Colin, I want to have more of my portfolio liquid. And if I use a CD or a fixed annuity or a structured note by the bank or so forth, I have these delays to accessing my money. And so I want to have a certain percentage of my money liquid and available to me at all times, just in case. And I might first say, be thoughtful about that, because liquidity is a choice that affects the other things you want. Because there's really three things you want. You want liquidity, you want safety, and you want growth. Okay, but you can't get 100% all three. In other words, there's always a compromise somewhere. There's always a compromise. So if you say, well, I want it to be totally safe and I want amazing growth, you probably aren't going to be 100% liquid. But if you're willing to compromise and say, okay, I'll be a little less liquid, access to my money, but not maybe immediate access to liquidate the whole account, well, that's a compromise on a portion of your portfolio in retirement that's very wise, because guess what that gets you? By compromising some on liquidity, you get access to principal protection and amazing potential upside growth that mirrors the performance of the market. As we talked about in our previous segment, these types of tools can actually outperform. And it's been studied since 1995, rolling 5-year periods actually outperform 67% of the time over the mighty S&P 500. You say, okay, I love great growth. I love protection. I love, all the things that you're describing, but is there any additional tool that we can add to increase liquidity in addition to these structured notes, CDs, fixed annuities, and so forth? And the answer is yes. And so what we like to do is, together with your more aggressive side of your barbell, we talk about this concept all the time, the barbell being on one side your risk and on the other side your safety. But on one side of the barbell, you can also add some safety on that risk side and still be liquid. We call this concept a buffered exchange-traded fund. And an exchange-traded fund is just a collection of stocks or indices that you can buy generally at much lower costs than a mutual fund. So a mutual fund tends to be an expensive way to own the stock market. It's not your best way if you're looking for efficiency. I know there are a lot of people out there that recommend it as just sort of a mindless way to participate, but I would suggest exchange-traded funds, or ETFs for short, as a better way and more tax efficient if that's important to you. But once we get the ETF, it's based on an index such as the S&P 500. But we give up some of that upside. Okay, we give up some of the up in exchange for none of the down, and we can actually be 100% liquid. Okay, so you can enter this ETF, which is usually entered one time per month, and it can have a term of 6 months or a year, and during that term, it will protect you 100% from the downside as long as you're in it. You say, well, what if I need to access my money inside of that period of time? Great, it's still liquid, whatever the value is at that time. Now, if you want the protection and you're in a down market, we recommend wait to access until the end of that term. But you can access 100% of your money without penalty anytime, including during the term. So the value of the term is, this is the period we're protecting you. And of course, the idea is at the end of each period, we roll into another period of protection and another, and so forth. And we manage this on your behalf. So a very, very powerful alternative investment. And this is just one of many. As I mentioned, banks offer them in the form of structured notes, buffered ETFs, CDs, market-linked CDs, and so on. Life insurance companies offer this same capability within your life policy to grow and accumulate cash without risk. And then fixed annuities are your CD alternative that offer the protection and the growth opportunity, but more liquidity than a typical CD. So a really good tool for a retiree or somebody planning ahead for your retirement. So not just when you retire, but you can actually plan ahead. And we'll talk more about this in future segments because we want to get ahead of the retirement phenomenon. We don't want to wait until the day before we retire. Literally had somebody do this, say, oh, I'm putting in notice tomorrow. I'm like, stop, wait, let us catch up. Let us do an analysis of your expenses and your income and figure out how to make sure you never run out of money before you run out of life. And that's the essence of retirement freedom, isn't it? To know that no matter what happens, you are secure. You don't have to worry about the cash flow stopping on you because of market volatility or failed income strategies or failed bond diversification, all the things that so many people have experienced and will continue to experience who are not working with a specialist in retirement. I just want to say a couple words. We are specialists at Lord & Richards in developing an income plan that you can outlive, abundant income. This is different from your accumulation advisors who simply focus on growing your nest egg. What's harder? What do you think? Drawing that money out while you're trying to accumulate or just accumulate? I think the first is harder. And in addition, we're specialists in risk management. You don't want to go into your retirement wondering what the downside is on your portfolio. You want to know it and you want to have a plan around that. And then we're specialists in helping you manage the high costs of healthcare in retirement, which can be overwhelming. And we do it through non-traditional solutions. We don't use traditional long-term care with all of its expense. This and many more specialties make us your retirement partner of choice. We would be delighted to visit with you to conduct a retirement freedom review at no cost to you. I would love to have a conversation. It simply starts with a phone call.